Hey, what's up everyone and welcome to the School of Personal Finance. April, it has not been a good month for the stock market so far. Things are pretty ugly out there. In this video, I'm going to try to coach you through this volatility, share some numbers with you, go through what the markets have been doing, and also give you some strategies of what you could be doing to maybe take advantage of this market volatility. I hope that you find this one helpful. Let's get to it. So I'm shooting this video down to my home office again. I would love to hear your thoughts about the sound quality, the video quality. It feels weird not being up in my usual spot in front of the fireplace, so maybe I'll rotate back and forth, but please drop me a note down below. Let me know how it all looks and sounds. And also make sure to go over to schoolofpersonalfinance.com, get on my email list, download the free PDF, 15 numbers that you need to be tracking to become great with money. Also connect with me on LinkedIn. I'm posting over there daily. All right, so let's start talking about the markets. So now I'm gonna go ahead, I'm going to share my screen with you and we'll go through some charts, some performance numbers. I mean, it's been a bloodbath over the last month, so there's not too many pretty things to show you in this video. But it's important to remember that we are investing for the long term. We are not looking to time the market or trade in and out of positions. So these downturns in the market, if anything, I'm looking at them putting my shopping list together of assets, of things that I would like to accumulate more of. So as the price goes down, I could go ahead and step in and try to buy more of these things. You can't look at your 401k statements or your brokerage account and be like, wow, I used to have this much money and now I only have this much money. So I lost all of this money. So many people tend to do this. They look at their high watermark, the highest amount that they ever had in the account, and that's where they always judge everything by. They say to themselves, wow, I just lost $100,000 over this last quarter, or whatever the case may be. You just can't look at it that way. You're investing for the long term. So as things drop and go down and we lose 20% in the market, you really have to look at it like, all right, I now have an opportunity to buy these things that I already own some of. I could buy more of them now at these lower prices and get that list together so that you could go ahead and take advantage of these opportunities. I know it's easy for me to say, but it's also very hard to do, to look at it this way, because it's painful when you lose money. And when you see that my account value just went down by 20% or whatever the case may be, that is a very painful thing to recognize and to deal with. But it's just the reality of this. These corrections, they happen much more frequently than they have over the last 10 years or so. All right, so let's jump in and see how the three major market indexes have done year to date. So the three indexes that you see, like when you turn on CNBC, are the Dow Jones Industrial Average, then we have the S&P 500, and then the NASDAQ. So the S&P 500 is usually what's used as a gauge for the overall stock market, and it's actually the largest holding in many retirement portfolios. Like you might have an index fund of the S&P 500 as your core holding inside of your retirement accounts or your brokerage accounts. So that's a very widely tracked index that people use to see how is the overall market doing. And the Dow Jones, that is really just made up of 30 industrial stocks in the Dow Jones index. And then you have the NASDAQ, which is more technology focused. Like the NASDAQ 100, you're going to have the largest tech companies inside of there. You know, the FANG companies, you have Facebook, Apple, Microsoft, Google. All of those companies are the biggest holdings in the NASDAQ composite. So now the Dow Jones has performed the best so far year to date. It's down 8%, where the S&P is down a little bit over 12%, and the NASDAQ is down about 20% year to date. And we had a sell-off in March, and people were hoping that that was going to be the low for the year and we would start to rebound out of it. And we did have a rebound, but now these last few weeks, the sell-off has just accelerated big time, and it looks like we're about to make new lows right here. So the NASDAQ did actually make a new low, and it looks like the overall market wants to make a new low as well. So if we look at just 1 month performance, if we go back a month, we could see that the NASDAQ is down just about 12% over the last month. So that is pretty painful. You know, the S&P down 8% over the last month. So if we just go back and we look at 1 year performance, I mean, now we've given up most of our gains over the last year. So as crazy as it sounds, the NASDAQ is actually down 11% over the last 12 months. So that's pretty nutty considering that the market felt like it was doing so great. Just it was November that we were hitting highs and everything seemed to be, you know, chugging along. But the last 3 months, 4 months, it's been pretty painful. The Dow Jones is basically flat over the last year, and the S&P 500 is up 1% over the last year. So we've given up a lot of gains over these last 4 months. Now, if we look at a 3-year time period, we can see it paints a different picture. Now, this includes COVID, so we had this big move down, back when COVID first came out, and then we had this huge move up over the last few years. So it's just been an amazing run, and the fact that we're giving some of it back right now, it really shouldn't be any big surprise. I mean, it's impossible to time these markets and to know exactly when it's going to happen, but we can't really be that surprised that we are in the midst of a sell-off. And a lot of things have changed in the economy, with the Federal Reserve, with interest rates. We're in a different environment now, so our expectations going forward, they also have to be different. Nobody knows what the future is going to hold, but honestly, I don't think it's going to be anywhere near as good as it has been for the last 10 years. So we might be in for some more pain, in for some sideways action. We could have another run up and then the slowdown. We just don't know what is going to happen. But we've been spoiled over this last decade of these double-digit returns year in and year out. We just can't expect that going forward. Now, if we look over the last 3 years, even with this most recent sell-off here, the Nasdaq is still up over 55% over that period. The S&P 500 is up 50% over that period, and the Dow Jones is up 33%. So it's interesting to note, that the Nasdaq is getting beaten to hell right now in April, but over the last decade, really, it has outperformed everything else by a pretty wide margin. So if we look at like a 5-year period as well, the Nasdaq 117%, the S&P 500 90%, and the Dow Jones 77%. Over a 10-year period, the Nasdaq Composite up 360% compared to the S&P 500 at 254%, and then the Dow Jones at 217%. All right, and now with this chart, I just added some of the most popular investment funds that people own out there, and we could compare them to the S&P 500 over these periods of time. So if we look at like year to date, the Vanguard Total Stock Market Index Fund, one of the largest funds in the world, that has been pretty similar to the S&P 500. So year to date, it's down 13% compared to the S&P down 12%. Then we have the Vanguard Total Bond Market Fund. Now, bonds, people think of bonds, they think of it being more safe and secure and stable, but the bond funds, they've been going down pretty rapidly over the last year or so. As interest rates go up, the value of bonds go down. So they haven't been a safe haven in pieces of the retirement portfolio. So this is a scary time for bond investors, for investors who are in retirement, approaching retirement. There really hasn't been anywhere great to hide, and you're losing money right now in these bond funds. So year to date, that Vanguard Total Bond Market ETF is down 8.5%. And now these two target date retirement funds, the 2050 target date retirement fund, those are for people who are looking to retire around the year 2050. So that is a more aggressive fund, and it's down about 12.5% year to date. And then the 2030 target date retirement fund, that's for people looking to retire around 2030. That fund is down 11.27% year to date. So just crappy returns across the board in all of these funds. But let's zoom out a little bit. If we go to like a 1 year, everything is still basically negative over a 1 year period. Just the S&P 500 is pretty much flat. It's up 1%. So if we look at a 3-year period, the bond fund's still only at 2% over the last 3 years. The S&P 500 about 50%, the Vanguard Total Stock Market Index Fund 46% over that period. And then for these target date retirement funds, these are going to be significantly less than the S&P 500 because they have that bond piece inside of them. Now, if we zoom out and we look at a 10-year period, I mean, it's pretty crazy to think over a 10-year period, the S&P 500 is up 263%, and the Total Stock Market Index Fund 250%. The Vanguard Total Bond Market ETF is only up 20% over that 10-year period. That's pretty crazy to think. And that's not annualized, right? That is over 10 years, it is only up 20%. Another thing that I like to look at on here is growth of $10,000. So if you invested $10,000 going back 10 years, in the bond fund, your $10,000 would only be worth about $12,000, where your $10,000 in the S&P 500 would be worth a little bit over $36,000. So it's pretty crazy to see. Over the 10 years, even in the 2030 target date retirement fund, your money will have doubled. So that means an annualized rate of a little bit over 7.2%, right? The rule of 72. So over 10 years, if your money doubles, that means that you earned 7.2%. So this is done a little bit better than doubling. So, 7.5%, somewhere in that range has been the annualized return, even in that 2030 target date retirement fund. So pretty interesting to look at. All right, so now let's switch gears and talk about these mega cap tech companies. So now these tech companies, they are really what has driven the market higher and higher. And even if you don't own these individual stocks, you own these companies through different funds. So if you invest in the S&P 500 or in the NASDAQ, in these different mutual funds, that you have the Vanguard Total Stock Market Index Fund, these companies, they are the biggest holdings inside of these companies for the most part. So they are really what drives the market up over the last decade. That's why the NASDAQ has outperformed everything else, because these companies are the biggest percentage of the NASDAQ. But now they're starting to roll over, and year to date, it's been pretty ugly with these stocks. So let's look at some of the most popular ones. So now year to date, Apple has actually held up the best out of all of them. It's down a little bit over 10% year to date. Microsoft down about 15% year to date. And then Google down a little bit over 20% year to date. They just had earnings yesterday and missed, so that stock is selling off today. Meta down almost 48% year to date. It has been a rough road for Facebook. Amazon down a little bit over 16% year to date. Tesla down about 15% year to date. Nvidia, which is down about 37% year to date. It's had such a big run, and now it's giving back a lot of those gains. And Netflix has just been obliterated after their latest earnings report and their warning that they're losing subscribers. It is down almost 70% year to date. So all of these numbers, they are very ugly and they scare the crap out of everybody, right? But if we zoom out again, it's like they've had such tremendous growth that they're just starting to give it back right now. That's what's going on. So if we take a look at a 3-year period, Apple is up over 200% over the last 3 years. That is pretty crazy. Microsoft, 121%. Google, just about 80%. Facebook is actually down 10% over the last 3 years. That's how much it has given back. It has been a rough ride for Facebook over the last few years. Amazon's up 43%. Tesla, it's up 1,800% over the last 3 years. If only we all just invested all of our money in Tesla a few years ago, we'd be doing pretty good right now. Nvidia up 320%, and then Netflix, like Facebook, it has just been obliterated as of late, down 50% over the last 3 years. But the point of this video is really just to remind you that everything that's happening right now, even though it sucks and we don't know how long it's going to last or how bad it's going to get, and it feels like things are really changing out there as far as financial conditions, the economy, everything going on, the point is that we do go through these types of cycles, and it always feels different. It always feels like, well, this is the one that's really going to put us under, but it has never happened before. So the best thing to do is to just take a step back, continue doing what you're doing, stay the course, try to keep adding money into your retirement accounts, into your investment accounts, look for opportunities, come up with your list of things that you would like to be shopping for. So like for me personally, I've been talking about gold a lot recently, and I've been adding to gold. I continue to add to gold. I like it as a diversifying piece of my portfolio. Now again, my disclosure, none of this is investment advice. I'm just sharing my opinion just for educational purposes only. Talk to your financial advisor about what's the right decision for you. But I'm trying to add to gold. I'm looking for opportunities to add to these big cap tech companies as well. As we have these pullbacks like Google and Microsoft and Amazon and those types of companies. I'm also looking to add to Bitcoin as well. I've talked about I-bonds in previous videos recently. They're paying a great rate right now for safe and secure money. So that's something that you could look into for some cash that you might have in the savings account. But I say, buckle in. The ride is here, right? There's going to be volatility. It's going to be a crazy market. Patience is also a great thing. You don't have to do anything at this point. There's no big moves to be made. The last thing you want to do is to get your account statement or to turn on the TV, see the markets are down, see how much money you lost, and be like, oh my God, I need to get out, get me out of all this stuff, especially if you have that long-term time horizon. You just have to look at it like it's an opportunity to accumulate more assets, but don't feel like you really need to do anything. You could take it slow and easy. We might have years and years of grinding this out, of going into a recession, having a bad economy, prices coming down. So, I always talk about in these types of environments as well, paying off debt, right? Getting yourself on solid financial footing. So don't freak out, don't panic. It could get worse before it gets better. We might have a much bigger drawdown. Who the hell knows what's going to happen? But you just have to be financially prepared and not make any drastic moves in hindsight, because of a reaction to what you're seeing on TV or what's going on in the market or what your account statement says. Stay the course, long term, keep accumulating assets, diversify your portfolio, try to do the smart things going forward. Don't drive yourself crazy looking at this stuff. All right, everyone, that is it for this one. I hope that you found it helpful. Please make sure to hit the like button if you enjoyed it. Subscribe to the channel if you've not done so already. I'll see you again in the next one. Thanks.